Seminar 2 continued. Inflows and outflows of cash. The statement of cash flow summarizes the inflows and outflows of cash during a given period. A decrease in cash flows is an inflow of cash because when cash that has been tied up in an asset is released, it can be used for some other purpose. Increase in cash flows represents an outflow of cash because additional cash is being tied up in the cash balance. I know this is a hard concept kind of to get used to, so I've kind of outlined it here for you. I think the same thing is in your book. Inflows and outflows, I've separated them. So the inflow is decrease in any asset and increase in any liability, net profits after taxes, depreciation, other non-cash items, and sale of stock. Outflows are increase in any asset, decrease in any asset, a net loss, dividends paid, and repurchase of retirement of stock. Operating cash flows, OCF. Cash flows generated from normal operations, which are normal operations are considered selling and producing the company's output of goods and services. Net operating profits after taxes, NOPAT, is calculated as EBIT 1 minus T. So what that means is earnings before income, earnings before interest and tax, and 1 is the 1 is minus the tax rate. That's what T means. So converting NOPAT to OCF is NOPAT plus depreciation, or EBIT times 1 minus T plus depreciation. And here's an example in numbers. So I have 250 times 1 minus the tax rate of 35% plus depreciation of 50 comes out to 162.50 plus 50 of depreciation is a total of $212. So free cash flows, or FCF, represents the cash available to investors after the firm has met all operating needs and paid for investments in net fixed assets and net current assets. So FCF equals, or free cash flows equal operating cash flows, net fixed assets in investment in FAI minus net current asset investment, NCAI. So NFAI is change in net fixed assets plus depreciation. There's a really good example in your book on page 122. Page 122 is detailed, so I didn't put it in here, but I think you should review. So the time value of money, it is better to receive money sooner than later because the money you receive today can be invested to make a positive investment in the future. So a single amount, a lump sum amount held or expected in the future, for example, receive $50 today, $40 to be received at the end of the next year. Annuity is a level periodic stream of cash flow, receiving or paying $50 at the end of each year for the next 5 years. And the mixed stream is unequal stream of cash flows with no particular pattern, such as year 1, $50, year 3 was $30, year 4 was $20. So future value of a single amount is the amount of money in the future if deposited today and earning interest. Applies compound interest over a specified period of time. Present value of a single amount, current dollar value of the future amount, the amount of money invested today at a specified rate to equal the future value. This is often referred to as the discounted cash flows. Ordinary annuities, where the cash flow occurs at the end of the period. Annuity due is annuity where the cash flow occurs at the beginning of the period. So the value of an annuity due is always greater than the value of an identical ordinary annuity because the cash flow of the annuity due is at the beginning of the period rather than at the end. This means that money is received sooner, so the future value is greater. Now here's an example to use in Excel. So on the FX or formula bar in Excel, you're going to select financial. It's a category drop down of all the different types of Excel formulas that are used. So you're going to have statistics and other things that are in there, and you're going to select financial. And if you do use Excel, you're going to get the most recently used. So I don't know if you use future or present value, but anyway, it's under financial. So in the drop down, select FV for future value, PV for present value. So an example, future value of annuity, the rate is 0.08 or 8%. You have to put in 0.08, representing 8%, or actually put in 8 plus the percent sign, because if you just put in 8, that's going to give you 8. So it's going to not give you the right formula at all. It's going to be way off. So NPER, or NIPER, is the total number of payments, power payment period. So in this case, it's going to be 5 years, so you're going to put 5. The payment, now I have the 100 in a parentheses representing a negative sign. I think you could either put, in Excel, you can either put the negative sign or you can put parentheses. But this is the outflow of cash, or the payment. PV is the present value of the money. We're going to put in $1,000. So for type, now this is where you're going to differentiate between if it's whether annuity or annuity due. So 1 is annuity due, or due at the beginning of the period, and 0, or if you don't put anything there, it's going to calculate it at the end of the period. Next slide. This is small, but if you could enlarge it, you can see this is the window that you're going to be putting this information in, because this is really what I want you to do for your last assessment question. What is the answer to the previous slide? So you can go back to the previous slide, take all the information that we put in there, insert it in your Excel spreadsheet here, and then all you have to do is give me the answer. All right, that's the end of Seminar 2. If you have any questions, please feel free to contact me. My office hours again are Central Time from 7 to 9. I will open up a chat room, or you can call me or email me, whatever you'd like to do. All right, have a good evening.